So many investors make a zero growth in their investment in their first 60 days. If you took a proper analysis of your investment, it's very easy to realize that you are making a zero return, real growth in your investment in the first 60 days. This is attributable to the incidental costs related to your investment that you ignore or do not factor in when you are calculating your investment. A question has been asked to me on the costs relating to funding our money market funds, that is the purchasing of units or what you would rather call deposit, and the liquidation or withdrawing, which we properly call sale of units from the money market funds. There are costs relating to the specific channel that you use to deposit or withdraw money from your investment, and some money market funds limit the investors to one channel, and that's giving you no option or flexibility in order for you to be able to manage those expenses relating to your investment. Most investors have not identified such instances, and if they took a keen analysis of their investment, it's not surprising your analysis conclude that you made a zero growth in your investment the first 60 days. We'll be looking at a short analysis, a simple analysis to support that, and also a recommendation on what you need to be doing as an investor in order to avert such expenses or minimize those expenses, because at the end of the day, it is profits or net returns that grow your investment, real investment, not just the items or figures that appear in your statement. We have to look at the period before the money landed into your investment vehicle and the period before the money landed in your pocket or back to you via a withdrawal. All those are expenses relating to your investment. High-end investors do have their personal bookkeepers or personal investment accountants to make sure that investment expenses are kept at the very minimum to ensure there is real growth in investing. We shall be looking at all those details after 3 seconds short break, so don't go away. And in the meantime, give us a like to this video, engage in the comment section, and try to answer a question or two that are being posted in the comment section. And we shall always come back to that comment section to see what questions you have in order for us to answer, and probably a video on areas that you want us to look at. See you after 3 seconds short break. Welcome back, and thank you for your like. If you are new to the channel, give us your subscription and don't forget to hit the notification button, because next we are uploading a value-packed video and YouTube should send you a notification if you do that. For us to understand this simple concept, we need to look at basic features about money market funds that are not fully digested by very many people. And the first one, we'll look at strategy. Every fund manager enters the market with a strategy. It's very important to understand the strategy of your specific fund manager. Number two, never ignore the level of customer service and customer experience, because that is the only way you can address many of the issues that may crop up in your investment. But the most important for our analysis is flexibility. Flexibility has been said only to surround the question of investing and liquidation of the investment. Being able to invest or deposit funds in that account as often as your ability can allow, and access to your money or withdraw from the account, is what has been described as flexibility of a money market fund. But flexibility goes beyond access of your account. Flexibility is about options. How many options or investment vehicles is the fund manager giving you? He has a money market fund, the fund manager has a fixed income fund, the fund manager has a special fund, the fund manager has another. Those are options. You are able to hop from one vehicle to another vehicle within the same fund manager, either for a second layer of diversification or to maximize on returns based on the periodic changes in returns in the market. Flexibility also will apply on the number of channels that this fund manager has made available to you for funding or depositing your money and accessing your money from your investments. Because it is those options in the channels that give you the ability to adjust your costs related to your investment. And that is our primary property of your investment in a money market fund that you need to look at if you want to manage or minimize your expenses, costs that are relating to you depositing money and withdrawing money. Because as you ask, or as you point out, these charges can be eating or they literally eat into your real growth. Some old men said that it's better a bird in hand than two in the bush. These expenses that you or the costs that you are incurring in depositing money and withdrawing money from investment are ignored by majority of retail or small investors. High-end investors, they have their accountants who take into consideration all those expenses, because at the end of the day, we are not only settling on the investment, or we are not only settling to the statement of the specific money market fund or any other investment vehicle that we are applying. We are also looking at the costs relating to the pre-investment period, relating to the transaction in depositing or transferring the funds to the investment vehicle, and the post-transaction costs related to liquidation. How much are we charged to withdraw money back into our pockets? Those are incidental expenses. Those are direct expenses that are related to your investment, and they are supposed to form part of your analysis. The most talked about really return is after we have taken care of withholding tax of 15%, after we have done inflation. That is what is said to be a real return. But that is ignorant of those particular expenses relating to that. And through this example, want to bring out the fact that a small investor can easily be making zero growth in their investment in the first 60 days of their investing because of their funding expenses, costs relating to depositing. This scenario would be worsened if you were to take care of the costs relating to withdrawals, because we have small investors putting money in their investment in a money market fund and withdrawing that money even before it has been invested for 3 months. This analysis will also help you to understand some 5 simple basic things about investing and the 3 reasons why we hold money. Looking at an individual who has deposited 2,000 shillings. I love using small figures because this channel believes that cadre of investors have been left out in most of our analysis, and most of other channels and reviewers, we talk of the millions, the tens of millions, hundreds of millions, and their allocations in creating different portfolios. For a small investor, we may not talk about creating portfolios because of we are in the stage of building or accumulation of assets for that portfolio spread. If an individual will send money in their money market fund, there are 3 options. And this one, I'm using an example of ethical money market fund. You are given 3 channels. You can fund your account using M-Pesa. You can fund your account using SasaPay. You can fund your account using a bank transfer. Convenience costs. Convenience can be a big destroyer of your returns. And convenience is by using the most available method or option without considering the cost. These investors assume they are funding their account using M-Pesa option. To send that 2,000 to your account, you will be charged 20 shillings for that transaction alone. If the same investor transferred the 2,000 by bank transfer, this investor would incur 2 shillings and 26 cents. That alone gives you the magnitude of the difference in utilization of those two channels. If I transfer the 2,000 from my account, my equity account, to Etika unit collection account, because the custodian is equity, I will incur 2 shillings 26 cents for that transfer. If I choose to fund my account with 2,000 shillings via M-Pesa, I'm going to be charged 20 shillings for the same transfer. So those options of two channels that I am given to choose from, I will either save 18 shillings or incur an extra 18 shillings. But to bring out the magnitude of that choice or the importance of that choice is now when we go down to calculate how much do you make as a daily return on these 2,000 shillings. A first calculation, we are looking at the daily rate and we are picking the current rate of 13.81%. 13.18%, we will first adjust it for the withholding tax, so we get a rate after tax. 15% of 13.81 will give us 2.0715% as the tax element. So deduct this 2.0715 from 13.81 and we are left with 11.7385% as our daily rate. The daily rate is a straight line rate. So the daily rate, you just divide it by 360 or 365 days, whichever is forming the year, to get the daily percentage. If you divide that figure, the 11.7385, to get the daily rate, we also have to think about the inflation, because we have an inflation component that should give us our actual real return. If you were to deduct the 3.5%, which is the prevailing inflation rate, from 11.7385, then we will be getting 8.2385 as our real return after tax and inflation. But now, remember, this individual has suffered costs in depositing this money in their account. And we have calculated they either incur 2.26% by bank transfer, or you decide to lose a bird at hand to go for two in the bush by incurring 20 shillings for the same deposit, meaning that you have suffered an injury, additional injury of 18 shillings for the same transfer because of your bad choice of option. Convenience. And that cost, we don't use it to calculate our real return. But our calculation will give a 0.45 or 45 cents as your daily return on 2,000 shillings for a fund or a money market fund that is paying you a 13.81 as your daily return. So the question is, if you are getting a daily rate of 0.45%, how long will it take you first to recover the 18 shillings, the 20 shillings that you incurred in making this money available for the investment? And the calculation will give you at least 45 days. That is 1.5 months. Those daily rates that you are getting for the next 45 days, when you download your statement from that money market fund, you will celebrate. At least you are seeing some returns coming in. But because you ignored determination of the cost that you are incurring in funding your account, in real situation, you are still not making any money. Up to completion of the second month is when you will start making some cash. Woe unto you if you make to withdraw a part of that investment before the exhaustion of the second month. You are going to incur another cost in withdrawing that money from the money market fund back to you, which again you are not going to consider in your determination. At this point, I think I would have made sense if I argue out this is one of the many reasons why the rich remain rich while the poor cycle because of ignorance. All costs relating to your investment have to be considered. And this reminds me of a very common, simple process that is we do in business. As an accountant or bookkeeper, one of the assigned jobs every month is to do a bank reconciliation, where you are reconciling whatever is in your bank statement or what you have in your bank account vis-a-vis what has been recorded in the business in your transaction books. And the key thing that in the reconciliation you are looking for potential errors. You are looking for missing information in these two books. And again, you are looking for charges. How much are you incurring in facilitation of those transactions? Because at the end of the day, the bank charges, you accumulate them over the 12 months, and that figure has to be included when you are determining or you are preparing your income statements. The same should apply in your personal investment journey. You are in the business of investing. Instead of running a side hustle of a business, which in most cases we also don't do or we don't prepare books. So we never get cognizant of the totality of all the expenses that we are incurring. That simple analysis proves to you and gives you the importance of giving time to your investment, because it is only time through compounding that enables you to recoup all the returns and cover all the expenses towards your investing. We will look at the other four after time as a factor, and you have seen how time becomes an integral factor in your investment after another 3 seconds short break. And in that time, you'll also be looking at the other attributes about money market funds that are important. See you after 3 seconds short break. Welcome back. And to put some salt on that wound, let's look at investment costs or costs relating to your investment within the fund manager ecosystem. We have divided our total expenses or costs relating to investing in three. There is the pre-MMF or pre-fund expenses, what you are incurring to transfer your money into the fund. Then there are those costs relating to the fund itself. And there are other expenses, or the category 3 is the cost that you will incur in withdrawing money from the fund. Our first analysis, we have looked at the two extremes. What you are incurring before your money hits the MMF account, what you are incurring after MMF account. It's important as an investor you be aware of the costs relating or costs that you are going to be incurring while investing. As your money compounds in that investment, are there some specific expenses or costs that are being charged into your account? One common one is a ledger fee. A fund manager could be charging a fee on a monthly basis for maintenance of your account. That is what we call a ledger fee. And that fee is on and above the usual management fee. Another cost that could be charged is a performance cost or a performance fee. Those investment vehicles, not necessarily a money market fund, we have investment platforms which give you a target return. That target return, what applies to that investment as a cost is a management fee. Once the fund manager exceeds the target return in any particular financial period or investment period, there is an extra fee that will be charged in your account out of that year's return that has exceeded, the portion that has exceeded the target return. That is a performance charge, and a performance charge can range between 5% to 10% depending on the fund manager. We have entry fees and exit fees. Those are administrative expenses relating to joining the fund or exiting the fund. Those expenses will also play a crucial role into eating into your returns. But the performance fee is exceptional because it only happens when the fund manager has exceeded a target return that is way beyond normal returns in that investment vehicle. Another important item that has caused a lot of discussion by many people is about the stability of a fund manager. Stability has been viewed by many people in terms of the fund manager, is he owned or a subsidiary of a parent company that has a huge distribution network in the country, or a known company. That is in the disregard of the fact that all these fund managers, regardless of their shape and size, they are all regulated by the same body without regard to their size. All these fund managers are registered by the same body without a regard to their balance sheet size. Then the most important question about stability is answered by the segregation of the investor funds and the fund manager funds. The fund manager never comes into contact with the investor money. The amounts that are deposited by investors in the custodian account, that account is domiciled with the custodian bank, and the fund manager has zero access to that money. In fact, the custodian bank prepares and maintains records that must reconcile or be in agreement with the records that are kept or maintained by the fund manager, because they are accounting for the same money, the investor money. Any discrepancy between those two accounts must be addressed through a periodic meeting by those two parties, the custodian and the fund manager, and that report must be tabled to the regulator before the regulator periodically. It's usually on a monthly basis. So regardless of the size of the fund manager, the fund or the investor money is secure. The regulator serves that purpose, and the ecosystem is designed in such a way to protect the investor funds. A recent event or a recent occurrence that strengthened that observation is what was happening with the Genghis Capital and their debt with a South African businessman. People were waiting for some bad thing to happen with the fund manager and probably the money market funds or the investment vehicles that they manage. And that was the Mali Money Market Fund and Gen Cap Ella Money Market Fund, which actually improved in their performance during that period. It's because the fund manager resources are separate from the investor resources, and the fund manager is required to organize his business in managing the funds with their own resources. And because fund managers are required by regulation to publish their financial statements, not financial statements of the fund, of the investor money, but their business, you should not be surprised when you find out that some fund managers have losses in their income statements. That has nothing to do with the investor money. Those losses are losses of the fund manager in his business of managing assets. And that cannot affect the investors in any way. It actually speaks to the owners of that fund, the shareholders of the company, because the fund manager is not an individual, but a company. It is the shareholders of that company who go back into their pocket to finance their own operations, but they cannot touch the investor funds with the custodian. That is to say that the custodian, even if was maintaining account of the fund manager, those two accounts will be separate and distinct without any relation. With that, then we conclude by looking at these 5 important but very simple things about investing that they are very important to you as an investor. And the first one is time. Time is a very important factor in investing. Compounding, the magic of compounding works in time. You must be able to give your investments enough time to build. The next item is return. Despite the good return as a percentage that you are getting from your fund manager or your money market fund, it's important you consider all those other incidental costs in determination of your real growth. A third one is incidental cost, and I think that one we have exhausted. That is a factor that you must be putting into consideration while investing, and very important, customer service. In some cases, customer service overrides return. And lastly, but not least, is cash. There are 3 reasons why we hold money. One is speculation, emergency, and transactions. Your money market fund is not your transactional account. Whatever you are putting in your money market fund is supposed to address emergencies if they occur. In the absence of an emergency, that is your investment that is building up. You should give that investment its ample time to continue growing and building to a point of saturation or a point of momentum where the money in that account, in your money market fund, is working harder than you. That point of saturation is where the return, total return that you are getting from the investment is higher than the total amounts that you have been putting in that fund over a period of 1 year. So you need to be holding enough cash for your transactions, not to interfere with the money market fund or the investment, because these costs that you are incurring in accessing that money, they are eating your real growth or your real return. Thank you for watching, and see you in our next video.